Hey guys, welcome back to another video, and today I'm here to talk about an option strategy that is going to make you money. So if you guys do enjoy this video, be sure to like it. Also subscribe to the channel. We just hit 200 subscribers. Thank you guys so much. Next milestone, 300. Waiting on it. Thank you guys for watching. Let's get right into it. So as we can see today, very good day on the portfolio. Very good day. We're up $600 and I can't complain. We can see the past 3 months we're actually up a little bit more than $600 if it decides to load here. But it has been a very good time in the stock market for me. This year, the past year overall, it looks like it doesn't want to load. But I am up about almost $10,000 in the past 3 months, year. Or yeah, here it is. So we have $8,700 in the past 3 months, and then we can see past year it's not going to want to load, but yeah, I mean, past 3 months we're up almost 60%. I can't complain being up 60% in 3 months, so I'm thankful for that. But the option strategy that we're going to get into today is a strangle. So this is a strangle on earnings, and I actually have a stock that you guys can use it on today. So I wanted to show you guys that I did end up purchasing this strangle on Tesla earnings. Did it go out the way, or did it work out the way that I wanted it to? Not particularly. It could have been worse. It could have been worse, but we'll see the IV crush tomorrow, because if I do simulate my returns right now, it's saying that tomorrow, or I mean, I bought options that expired pretty quickly. I didn't want to put that much into this play, but you can see. I mean, we'll see a market open tomorrow. If Tesla is still at the same price, then I probably lost a good amount of money. So, I mean, not a good amount, but I mean, probably like 70% of this option. But I'm willing to take that risk, and I think that there's more ways that you can make money than lose money with this option strategy. So basically what you're doing is you're using two standard deviations on the earnings of a company. So the company that I'm going to use as an example today is FCNCA. I don't know. I mean, I've heard about this company. I don't know much about this company, and we're solely investing in this for the option strategy. So what I wanted to show with this stock is you go on Market Chameleon, very great site. I'll link this down below. But you go to the implied moves and IV crush. So we're seeing that the options market overestimated FCNCA stock's earnings move 50% of the time, which is pretty low. Usually it's a lot higher than that. So that's pretty good for a company like this. That's really good that they're estimating that it's going to be 7.6%, but on average it's 6%. So that's pretty good, because with this strategy you need the move to be bigger than estimated. It can be in either direction, but you just need the move to be bigger than the estimation, because you're going two standard deviations out. So I'll show you guys the options that I'd use for this in particular. So with this one, we're going two standard deviations out. These are expensive options, but they get cheaper as you go out. But we'll see that, the implied move is around 7.6%. So we move that. So we'll move it 15%. So we're moving it 15% from 2,158. So that's about $300, a little bit more than $300. So we'll look at the 2,000, in the $2,400 call range. So $300 are at so these are expensive options for sure. But you see, we have the $2,400 call. We could buy that, which is expensive. Or we could buy, and then when we buy that, we also want to go $300 down. So that's about $300 up. Not quite, but we're going a little bit closer to the money. But then we go $300 down. So from 2,400, we take it back, and now we're going 1,800. So we buy a put for 1,800, and we see that this company has to either drop 17% or rise 13% with this spread that we have to make money at expiration. So a better way to look at this is we have FCNCA right here, right now, and we have that option on there. So what we got is a $1,800 put. So we'll put that right there. And then we got a $2,400 call. So this is a very expensive stock to be doing this with. But we can see FCNCA reports earnings on Friday morning. That's why I'd buy these options tomorrow. And this company, on average, if you check on Market Chameleon, on their release dates, on average, they move about, you can see that they've moved 10% before. So it's not that crazy to say that they're going to move 15%, but they have only moved 1% before, too. So you see the implied straddle as well is pretty high. But, I mean, this is the risk you take with this. But the thing is, if they do move that 10%, if they move that 15%, your option's worth a lot of freaking money. I mean, look at that. You can, over 10x your money if it just moves enough in the right direction, which, I mean, it could do even more than that. So, I mean, yeah, there's a lot that can happen, but we'll say that 15%, and then we drop the implied volatility. This is a part of the strategy that a lot of people forget to do. But you do need to drop the volatility because there is a volatility crush. If there wasn't a volatility crush after earnings, then the strategy would be pretty overpowered. But you can see the volatility crush is pretty high on this too. It's 22%. So the stock actually has to move in one of these directions pretty good. We actually should up the strike price of the put, in my opinion. So yeah. So you can see the stock has to move 12%, or we'd sell it Friday probably. So it has to move. If it moves 11%, we make 50%. If it moves 9%, we lose money. If it moves 7.6%, we lose 50%. And it's same thing down here. It's very, very close to the percentages you can see. So 2% is a huge difference in this. You can see that the difference between it dropping 12%, we make $500, and if it drops 14%, we make $2,000. If it drops 15%, we make $4,000. So 1 percentage point higher of a drop doubles our profit. And you can see this works the same way as we increase the range. If it does, what if they just completely just miss on every part of their earnings? Guidance is weak, companies doing bad. We're 10xing our money in either direction. If they do really good or really bad, we're 10xing our money. So the thing about this strategy that you can't give up on it. So the strategy you're going to lose. You're going to lose in this strategy sometimes, but you're also going to win really big. And when you win big, it's supposed to make up for the losses. So you can see you could do this strategy 10 times and you could lose 9 times and win once, and you'd break even. You'd probably more than break even. But you can see that one big move can make up a lot of the strategy. So I actually wanted to look at the earnings calendar too and look at some for next week. Next week's earnings should be a little bit more interesting. I'm not the biggest fan of FCNCA. I'm not sure how this company usually moves. But there are a little bit more volatile companies that I'd say are a little bit more worth using this strategy on. We can see Monday, there's some decent companies. There's Wells Fargo. I like that. I like investing in, some bigger companies. But I also like, they have Booking Holdings. That one can move. Spotify can move. Starbucks. I like that. And then you can also move down in this. PayPal. There's a lot of companies, you keep going. There's a lot of them that can move a lot. They're companies that do move a lot on earnings. SoFi right here. I don't hate SoFi. So SoFi reports in the morning on Tuesday. So I wouldn't hate buying a SoFi Strangle right now. I think that might be the play for this video as I'm recording it kind of last second. But I do think that a SoFi Strangle is kind of early because you have to wait for the weekend. This is next week. But a SoFi Strangle, I think the price of SoFi puts and calls will go up before, I think their IV rank will be a lot higher by the time that earnings happen. So I wouldn't hate buying those calls tomorrow. So we can see SoFi earnings on release dates. It's dropped 10% twice. It's gone up 0.5% twice. So SoFi moves very weirdly on earnings. We can see the implied moves is 12%. Or what does this say compared to actual move? That was not good last earnings, but it's overestimated at 77% of the time. So it happens a lot. But SoFi's in a very, very weird place right now. This earnings means a lot, I think, for SoFi. This is going to solidify a lot of stuff for SoFi. This is a big thing. So if we look at look at how elevated the price is. It's up 80% in the past 3 months. So I think this earnings is going to be an important one. I do own a good amount of SoFi stock, so I wouldn't even mind buying a put to just hedge my SoFi stock. I wouldn't hate that. But we do have a lot of money in SoFi, and we're up 80% in the past 3 months, all time, up almost 160%. But we see right here, the SoFi earnings are estimated to be 15% move in either direction. I don't think that's crazy. It's not that crazy. but we can see the earnings actually happen on the morning of Tuesday. So either buy the option tomorrow, Friday, or Monday. I'd probably buy it tomorrow because I think the IV is going to go up as we near earnings, which just the stock doesn't even have to move. But your your options are going to be more expensive, which I think is probably going to happen. So I wouldn't hate buying the Strangle tomorrow. I wouldn't hate buying another one before earnings. Maybe I think that your money is going to be worth more either way you go about this. But we're going to see right here that SoFi. So let's map out which options we want exactly. So the predicted earnings move for this is 15%. So we're saying SoFi moves 30% in either direction, which isn't that crazy. That's happened before. It's happened 80% in the past 3 months. So it's basically moved 30% a month in the past 3 months. One earnings can definitely do that. So 30% on a $21 stock. We'll buy the 9-day out because it needs to be after earnings. But we'll see it right here. So 30% on this would be about, we're buying a $26 call. I don't hate that. But look at how cheap these are. So this is one you can kind of, I'd honestly, maybe get a little bit closer on the Strangle because you're more likely to make money. These are just lottery, calls, but maybe go August 1st. And I mean, we're looking at option strat right here. So I don't hate buying one of these. It has to move a lot in either direction, either way. But SoFi stock is so cheap that the options are cheap as it is. So I wouldn't hate something like this where, you need it to move around 30%. But you also, so I think the IV is going to go up before it reports on Tuesday morning. So if you want to buy some with the intention of selling them before earnings, maybe do that as the IV increases because I think that will happen and the percentile will go up. I don't know how much. But I don't think it's that, I think it could go up around 30%. I think SoFi could run a little bit before earnings too. So I think I actually am going to get into some of these call and put positions tomorrow for SoFi. I'm not sure at what price, but I think the calls and puts are going to be worth more as we near earnings. But we see that the IV crush on SoFi is around 23%. So if we have that 23% IV crush, we're looking at something like this. So you can 3x your money on this pretty easily on Tuesday in either direction. If it does rise or drop 30%, we can see. But yeah, I mean, I really like SoFi on this. I think that it's a very cheap stock, a lot of cheap calls, cheap puts. And I think that getting into this right now isn't a bad idea, but definitely on Monday, it's a good idea. So yeah, that's all the plays I have for you guys today. I'll see how the Tesla play does tomorrow. I'll let you guys know, but I appreciate you for watching. If you do like the video, be sure to like, also subscribe to the channel. Next milestone is 300 subscribers. Thank you for watching. I'll catch you in the next one. Peace.